It's now time for me and my Roku, with your host Peter Clay.
Hello, Peter.
Incidentally, this is Peter.
So we have a voicemail now from Peter.
From a different Peter.
Peter was like my brother.
This is my brother, Peter.
Pete, you are not.
Not everybody sounds like Peter Clay.
Oh, I love Peter.
Holy crap, it's Peter.
All right, Pete, we're not friends no more.
I'm just trying to make friends with Pete.
Okay, I'm with you, Peter.
I sold it to a guy named Peter.
Peter Clay is here today.
Does Pete really need to be here?
Yes, he does.
Good luck tonight, Peter!
Last but not least,
Peter.
Come on, Pete.
Your host, Peter Clay.
Wow, okay. Talk about a plot twist. The Fed just slashed interest rates, and not just a tiny bit. We're talking a Hayes-Elf a percentage point cut.
Yeah, definitely not your typical Tuesday, right?
Not at all. So for anyone out there who's, maybe not glued to the financial news, why does this even matter?
Well, think of it like this. The Fed's decision on interest rates, it's kind of like adjusting the volume knob for the entire economy.
Okay, I like that.
It impacts, well, everything. What you pay for a mortgage, how much businesses have to shell out to borrow money, even what you earn on your savings account. It's all connected.
Right, and this big move by the Fed, it's creating some serious buzz, and not everyone's quite sure how to react. I mean, the markets are going wild celebrating, it seems.
Yeah, it's been a roller coaster, that's for sure. And that's exactly why we're here, diving deep into what sparked this rate cut, what it signals, and what it all means for you, the listener.
Exactly.
Yeah.
Because we're not just about throwing headlines at you. We want to make sense of it all.
Absolutely. So let's break it down. The Fed, they've got this balancing act they're constantly trying to pull off.
Yeah, they're always walking that tightrope, right? Trying to keep inflation in check, but also make sure the economy doesn't just, slam on the brakes.
Exactly. They're aiming for that sweet spot, that soft landing everyone's been talking about. But it's tricky. And this rate cut, it's got people wondering, is the landing going to be as smooth as they're hoping?
Yeah. Is this a sign that maybe things are a little bumpier than they're letting on? I mean, a half-point cut, that's a pretty big move, isn't it?
It is. And one of the sources we're looking at today, this market beat analysis by Thomas Hughes, he makes a good point. He says this cut, it's more aggressive than what we usually see, which suggests the Fed, well, they might be more worried about the job market than they're letting on.
So even though on the surface, unemployment's still pretty low.
Right. This could be a sign that they're trying to get ahead of things, give the economy a little boost before it potentially starts to sputter.
Trying to prevent that dreaded R-word recession.
Exactly.
And yet the markets, at least for now, seem to be popping champagne corks.
Right. The Dow jumped something like 500 points after the announcement, which, on the surface, seems a little counterintuitive.
It does, right. It's almost like, wait, are we celebrating or bracing for impact? So which is it? Should we be breaking out the party hats or battening down the hatches?
Well, that's the million-dollar question. The market's reaction, it makes sense to a point. Lower interest rates often mean companies can borrow money more cheaply.
So they have more cash to potentially expand, hire more people, and, ultimately boost their stock prices.
Exactly. But the question is, how long will this last? Is it sustainable? Or are we in for a bit of a sugar rush before a potential crash?
Okay, so the Feds hit the gas, the market's along for the ride, but where does that leave, us?
Right.
What does this rate cut mean for our own wallets?
That's the key question, right? And it's not a one-size-fits-all answer, unfortunately.
Because we're not all Wall Street hotshots, right?
Exactly. But even if you're not a day trader, understanding the potential ripple effects can help you make smarter financial decisions.
So where do we even begin to unpack this?
Well, one of our sources had some interesting insights on this. Nathan Rafe, over at MarketBeat, he highlighted a few specific ETFs that he thinks could be, poised for growth in this new environment.
Okay, ETFs. Now, I'll admit, sometimes I hear these financial acronyms and I'm like, hold on, let's rewind. So, for anyone else who needs a quick refresher.
Of course. ETFs, or exchange-traded funds, they're basically like, imagine a basket of stocks all grouped together.
Okay, so instead of putting all your eggs in one basket.
You get a little taste of everything. It's a good way to diversify your investments without having to buy, dozens of individual stocks.
Makes sense. Less risky, potentially.
Exactly. So this MarketBeat article, it points out 3 ETFs in particular. The first one is IJR, which tracks small-cap companies.
Small cap meaning?
Companies with a smaller market capitalization. So generally, smaller in size, maybe a little younger.
Startups, that kind of thing.
Could be. And the thinking is these smaller companies, they often rely more heavily on borrowing to fuel their growth.
Makes sense. They need that extra cash to, get their ideas off the ground.
Exactly. So when interest rates go down, it's like their cost of doing business just went down too.
Which means they have more money to potentially expand, hire more people.
And hopefully see their stock prices rise.
Got it. So if you're looking for growth potential, particularly if you believe in, the future of these smaller companies,
IJR could be worth checking out. Now, the second ETF Rafe mentions is VWO, which focuses on emerging markets.
Okay, so we're going global here.
We are, and this one gets a little tricky because it's tied to how U.S. interest rates affect the value of the dollar.
Okay, yeah, that whole relationship always makes my head spin a little. Can you break it down for me?
Sure. So when interest rates here in the U.S. are high, it tends to attract investors from other countries.
Because they're looking for a better return on their investment.
Exactly. And all that money flowing in, it increases the demand for U.S. dollars.
Which makes the dollar stronger.
Okay, I'm following so far.
Now, when U.S. interest rates drop, like they just did,
yeah,
the opposite happens. The dollar becomes a little less attractive to foreign investors.
So the dollar weakens. But how does that tie back to emerging markets?
Well, a weaker dollar means that goods and services from places like, say, India or Brazil, they become less expensive for U.S. buyers. So we're more likely to buy their products, which is good for their economies.
Exactly. And since this ETF, VWO, tracks companies in those emerging markets,
their stock prices could potentially benefit. Okay, so that's 2 ETX down, 1 to go.
Right. The last one is PFFD, and this one focuses on something called preferred stocks.
Preferred stocks. I feel like I've heard that term thrown around, but never really understood what made them different.
Well, think of preferred stock as kind of a hybrid.
A hybrid? How so?
They're like a cross between regular stocks and bonds.
Okay, that's a new one.
So they still represent ownership in a company, like regular stocks, but they also offer a fixed dividend payment, kind of like you'd get with a bond.
So you get a little taste of both worlds.
You got it. And here's the thing. These dividends, they're usually higher and more consistent than what you'd get with common stocks. Plus, they tend to react well when interest rates go down.
Why is that?
Well, when interest rates decline, those fixed dividend payments from preferred stocks, they start to look a lot more appealing compared to, say, bonds, which might be offering lower yields.
Makes sense. Investors are always on the lookout for that sweet spot of return and stability.
Exactly. So if you're someone who prioritizes income and you're looking for something that might offer a little more stability, this PFFD ETF, it focuses specifically on preferred stocks, so it could be worth exploring.
So we've got IJR for growth potential, VWO for tapping into those emerging markets, and PFFD for those who are really prioritizing that steady income stream.
You got it. But before anyone rushes out to, rearrange their entire portfolio,
we have to give the standard disclaimer, right?
Always. This is not financial advice, and we are not financial advisors.
We're just a couple of curious minds diving deep and trying to make sense of it all. So we've covered the Fed's rate cut, we've talked about ETFs and emerging markets. It's a lot to digest. But, even if someone's out there thinking, hey, I'm not a Wall Street wizard. I'm just trying to, afford my rent and maybe a weekend getaway every now and then. This stuff still matters, right?
It really does. This isn't just about people playing the stock market. It's about your life, your money, your future.
Exactly. So break it down for me. How does this interest rate roller coaster actually impact, the average person who's just trying to make ends meet?
Well, remember that volatility we talked about, how the market's kind of been on this up and down ride?
Yeah, like a roller coaster after too much coffee.
Exactly. And both of the articles we looked at today, they both agree that this bumpy ride, it's probably going to continue for a while.
So buckle up.
Right. And that volatility, it can show up in some surprising places. Like it can impact your 401k, even if you're not actively managing it.
Because the value of those investments can go up and down with the market.
Exactly. But it goes even further than that. Think about if you're planning to buy a house or a car anytime soon.
Interest rates on loans are definitely going to play a role there.
Big time. And even on the day-to-day level, that uncertainty in the market, it can make businesses a little jumpy. They might have to raise prices because their costs are going up, or they might hold back on hiring, just to play it safe.
Which then impacts everyone's job security, how much we're earning, what we can afford.
It's all connected. That's why it's so important to, even if you don't want to become an economics professor or anything,
just have a basic understanding of, the rules of the game.
Exactly. No one can predict the future. But the more you understand the forces at play, the better equipped you are to navigate those twists and turns.
Make those informed decisions for yourself and your family.
Exactly.
It's been quite a deep dive today. We've gone from the Fed's big announcement to the nitty-gritty of ETFs, even touched on how all this impacts our daily lives.
It's been great exploring all of this with you.
And, the conversation doesn't end here. Those articles we mentioned, they brought up some interesting points about, like, the upcoming election and how that might shake things up even more.
Definitely something to keep an eye on.
For sure. So to everyone listening, stay curious, stay informed, and we'll catch you next time for another deep dive. Crazy, right? We're looking at record highs for the stock market. Like, everything's booming. But then you come across articles talking about these undervalued gems and potential shakeups just waiting to happen.
Yeah. And that's what makes the market so interesting, isn't it? It's like both things can be true at the same time. And that's why this deep dive you've asked for today is so fascinating.
Okay, so let's break it down. You sent over 3 articles. On the surface, they seem totally random.
Right.
We've got the SEC proposing a new rule about how stocks are priced, and there's Mastercard dropping billions on some AI cybersecurity company. And then this piece about 3 companies, SQM, Intel, Boeing, that are supposedly undervalued. Help me connect these dots.
The common thread here is, well, it's about those hidden forces at play in the market. The stuff that creates opportunities if you know where to look.
Okay.
And sometimes those opportunities come from the rules of the game changing, which leads us to that first article, Halfpenny Revolution. How the SEC's new rule could totally impact stock pricing,
Yeah, this one had me stumped at first. I mean, half a penny, that's like, what, spare change you find under the couch cushions?
Yeah.
Not exactly something I'd think could shake up the whole stock market.
But that's what's so interesting about this SEC proposal, right? It's not about the halfpenny itself, it's what that tiny change does to how trading actually works.
Okay.
Right now, we price stocks in 1-cent increments. Might seem small, but think about high-volume trades or stocks that are priced lower. Those pennies, they add up.
So we're talking about the bid-ask spread, right?
Exactly.
So for us regular investors, how does a smaller spread, which is what the SEC wants, how does that help me?
Let's say you're buying, say, 100 shares of a company. The bid-ask spread is 5 cents. You could end up paying an extra $5 just because of that gap between what buyers are offering and what sellers are asking. Now shrink that spread down to a single cent with this new rule. Suddenly, you're saving $4 on that same trade.
Okay, I'm starting to see the bigger picture. But this isn't just about saving a few bucks here and there, is it? It's about making the whole market more efficient, which is what the SEC keeps saying in this article.
You got it. The SEC argues that this 1-cent minimum price movement that we have now, it can actually make things inefficient, especially in markets that move really fast or have high volume.
Makes sense.
A halfpenny step could smooth some of that out and maybe even lead to prices being more accurate overall.
But I'm sure not everyone's happy about this potential rule change.
Yeah.
I mean, Wall Street loves its loopholes. Something tells me this could really shake things up for the folks who are profiting from how things work now.
You're not wrong. The article talks about some possible downsides, like more volatility for certain types of stocks and maybe challenges for the market makers who provide liquidity. Some experts even say the benefits might be overblown and we could see unintended consequences down the line.
So it's a classic case of be careful what you wish for.
Right.
But even if it all goes exactly how the SEC wants it to, this halfpenny thing, it wouldn't impact every stock or sector equally, would it?
You're exactly right. The article points to high growth areas like tech and biotech. They're probably going to be more affected because their prices tend to swing a lot. So a halfpenny step could make those moves smoother. On the other hand, you've got those established, slow-moving companies.
Right.
They might not even notice a difference.
It really is amazing. Such a small change with potentially huge consequences. Speaking of making big moves, let's talk about Mastercard and that whopping $2.65 billion they're spending on AI cybersecurity.
Right. Buying up recorded future.
Recorded future, right. See, that's what throws me off a bit. I mean, Mastercard, they're all about processing payments, making sure my credit card works when I need it to, Cybersecurity, though, seems like, well, a whole different world.
It's all connected when you think about it this way. Mastercard's whole business depends on trust. Every time you swipe your card, you're trusting them with your information.
Yeah, that makes sense.
Cybersecurity isn't just about protecting data anymore. It's about protecting how we do business, the whole thing. And Mastercard's saying, we're not taking any chances.
Especially with all the cybercrime going on. Wasn't it something crazy like $8 trillion in losses globally last year? I remember reading that in the article. $8 trillion. That's like most countries' entire economies.
It's a mind-blowing number, and it shows why Mastercard's willing to spend, what was it, $2.65 billion?
Yeah, something like that.
They see AI as the big weapon in this fight, right? It can analyze huge amounts of data, more than any person ever could, and actually predict threats before they happen. And the article even mentioned how their existing partnership with this recorded future, it's already doubled how many compromised cards they catch.
Now that's a return on investment. So is MasterCard alone in going all in on AI like this? What about Visa? Are they doing the same thing?
Visa's interesting. They're putting a ton of money into AI cybersecurity too, but they're doing it differently.
Right.
More like building it themselves. Billions going into their own systems, their own partnerships, that kind of thing. Whereas MasterCard seems to want to just buy the companies that are already good at it.
So it's the classic build it yourself versus just buy the thing.
Yeah.
I guess both have their ups and downs.
Exactly. And you see it in who they're buying, too. MasterCard goes for this recorded future, which does a bit of everything when it comes to cyber threats. But Visa, they were looking at future space. They're way more focused just on payment fraud.
Huh. And the price difference between those two is pretty telling, too, isn't it?
Oh, definitely.
2.65 for recorded future, but feature space was going for what, like 900 million? That's a big difference.
It could mean a few things. Maybe MasterCard sees something bigger in recorded features' broad approach. Or maybe they just really want that tech now and don't mind overpaying a little. Who knows which one's going to come out on top in the long run?
It's like watching a high-stakes poker game, you know? These companies throwing billions around, trying to outmaneuver each other.
It's all strategy.
Which brings us to that last article, the one about finding opportunities where no one else is looking. These so-called, what was it, undervalued gems.
Right. And it's easy to misunderstand what that means. It's not about finding the cheapest companies out there, It's about spotting the difference between what the stock price is and what the company is actually worth, which, well, lots of things can affect that. Things the market might be misinterpreting or just not seeing.
Okay, so walk me through it. We've got SQM, Intel, and Boeing. Why are these the companies that are supposedly undervalued right now?
Each one's kind of a case study in how market sentiment, like the mood of the market, it can cloud people's judgment of what a company's really capable of. Take SQM, for example. They produce lithium. Lithium prices tanked recently, and of course that pulled their stock down with it. But that short-term freakout, it might be masking something much bigger, electric vehicles.
Because those all need lithium batteries, right?
Exactly, and the article points out some analysts think this is the perfect time to buy SQM stock. They're predicting a big jump in earnings once demand for electric cars picks up again. And that, well, that could launch the stock price way up.
Interesting. And what about Intel? They haven't been doing so hot in the semiconductor market, have they?
Not really. That whole oversupply problem has been hurting their stock. But here's the thing that's interesting. Even with their stock down, Intel's own CEO, he's been buying up shares. And so have other people who work there.
So they believe in the company, even if Wall Street doesn't.
Seems that way, right? Plus, less and less people are shorting the stock, fewer people betting against them. You put that together with the insider buying, it could mean Intel's about to turn things around.
It's like they're seeing something everyone else is missing. Okay, last one, Boeing. What's their story?
Boeing's had a rough few years. No way around it. Those incidents they had really hurt their reputation.
Yeah.
But you got to remember, Boeing's huge in the aerospace industry. People still need to fly, and they've got tons of orders waiting to be filled.
It's easy to forget about the big picture when you're just reading headlines.
For sure. And yeah, those incidents hurt their stock, but some investors think the market went overboard, like they overcorrected.
Meaning there's a chance to buy low.
That's the thinking. And just like with Intel, you've got less shorting going on, and big institutional investors, the ones with deep pockets, they're buying more Boeing stock.
So across the board, whether it's lithium, semiconductors, or airplanes, it seems like the lesson here is don't just follow the crowd. Look a little deeper.
Exactly. That's what value investing is all about. It's about looking past the surface, trying to figure out what's really going on with the market, with different industries, with how the companies themselves are doing. That's how you find those hidden gems.
It's about connecting the dots. And isn't that what we've been doing this whole time with these articles you brought?
Right.
Whether it's some new rule changing how we trade, or a big company betting big on cybersecurity, or just trying to find those companies that are undervalued, it always comes back to understanding the bigger picture.
And once you understand that, you're in a much better position to make good decisions with your investments. Because knowledge is power, right?
Yeah.
Especially in a market as complex as this.
Couldn't agree more. So to everyone listening, keep those questions coming. Keep digging deeper. You never know what you might find. Until next time, happy investing, everyone.
Work hard in silence. Let your success be the noise.
All right, so today we're diving headfirst into the world of real estate investing.
Definitely a hot topic.
It really is. And, we got to keep those shovels sharp with all the latest news. So we're doing a deep dive on REITs.
Real estate investment trusts, for anyone just tuning in.
Exactly. And we're doing this at a pretty interesting time, I'd say, because the Fed just threw everyone a curveball by slashing those interest rates.
Which, as you can imagine, has ripple effects on practically everything.
Yeah.
REITs, dividend stocks. We're unpacking it all today.
Exactly. It's all connected. And I love finding those threads between what seems like totally different areas of the market.
And that's what makes it so fascinating, right?
Absolutely. Okay, so to guide our deep dive today, we've got this Power Feed newsletter from Chicken Analytics.
Oh yeah, Joe Austin always brings up some really interesting points.
Mm-hmm. He really does. And this time he's talking about how REITs kind of got hit hard when interest rates were climbing.
Yeah, it's like suddenly your boring old savings account was the exciting investment.
Right. If you can get a decent return without much risk, just parking your cash in a high-yield savings account, who needs the stock market roller coaster?
Exactly. Why mess with a REIT yielding 3% when your savings account's offering 5% or more? But now the Fed cuts rates and boom, whole different ballgame.
So is this a sign that REITs are about to make a big comeback?
That's the million-dollar question, isn't it? Joe seems to think this rate cut could be a turning point, but he throws out this line that's got me thinking.
There's always a but with these things. Lay it on me.
He says, even if you love dividends, there might be better choices than REITs.
Okay, that definitely got my attention. So what's the catch with REITs, especially now with everything changing?
Here's the thing. To avoid getting slammed with corporate taxes, REITs are required to distribute most of their income as dividends. Sounds good on paper.
Right. Who doesn't love a steady income stream?
Exactly. But it can actually limit their growth potential.
So you're saying you might get that nice steady income from dividends, but your initial investment itself might not grow as much as, say, for high-growth tech stock.
Precisely. Classic trade-off. REITs are like the tortoises in the investing world. Slow, steady, reliable.
But some investors might prefer a faster-moving hare, even with the added risk.
Exactly. And that's where Joe's better choices come in. He's got his eye on high dividend-paying stocks.
Instead of REITs? Okay, I'm intrigued. Spill the beans.
He specifically calls out the Vanguard High Dividend Yield Index Fund.
Ticker symbol. Got to give the people what they want.
VYM, write that down. And he even includes this 5-year performance chart comparing VYM to the Real Estate Select Sector SPDR Fund.
Which basically traps the real estate sector as a whole, right? So how'd they stack up head-to-head?
VYM delivered better returns. And get this, with less volatility.
Music to any investor's ears. Okay, so less volatility, better returns. Why would anyone even consider REITs then?
Hold on now. Don't write off REITs entirely just yet. Joe points out that there are actually 13 different categories of REITs.
13? Seriously, I had no idea. So we're not just talking about your typical office buildings and apartment complexes.
Not at all. There are REITs out there specializing in everything. Data centers, cell towers, timberlands, even self-storage facilities.
Who knew? It's a good reminder that we got to do our homework right. Just because REITs in general might not be the hottest ticket right now doesn't mean there aren't some hidden gems within specific REIT sectors.
Exactly. It all comes down to thorough research, figuring out your risk tolerance, and setting those financial goals.
Absolutely. Okay, so if you're interested in REITs, don't give up on them entirely, but definitely do your research and consider those alternative investment avenues as well, like those high dividend stocks we were just talking about. Speaking of alternatives, you had some interesting info on a company called Grid Battery Metals.
They definitely caught my eye. Now, they're not directly developing real estate in the traditional sense.
But they're playing in that world somehow.
Oh, they're connected. They're focused on something just as essential in today's world. Raw materials.
You mean like mining? Are we talking about those EV batteries everyone's buzzing about?
Ding, ding, ding. We've got a winner. They're all about lithium and copper exploration, two metals that are absolutely essential for EV batteries. And their website is a gold mine of info, no pun intended.
Okay, now that is officially on my radar, but we're going to have to take a quick break. Don't go anywhere. We'll be right back with more on this fascinating company and some other investment angles you won't want to miss. Welcome back, everyone. So before the break, we were teasing this company, Grid Battery Metals.
Really interesting company.
They are. They're all about lithium and copper for EV batteries, but you said they're not directly involved in real estate. So where do they fit in?
That's the cool part. They don't build houses or office spaces or anything, but their work is super connected to this booming sector that's, well, it's driven by real estate trends.
Okay, you're going to have to connect those dots for me.
Think about electric vehicles, right? Huge demand.
Absolutely. Everyone's talking about EVs.
Exactly. But for them to be practical, we need...
Charging stations.
Yes. Infrastructure.
Yeah.
That infrastructure, it's got to be built somewhere.
Which requires real estate. Okay, I see where you're going with this.
Exactly. And that's just one angle. Think about the factories pumping out these EVs, the mines where they're getting the raw materials. It all ties back into real estate in some way.
And Grid Battery Metals is at the very beginning of that whole chain.
Exactly. They're the ones securing the lithium and copper that those EV batteries can't exist without.
So they're not building the house, but they're supplying the bricks, so to speak.
I like that. And speaking of which, their website really dives into their lithium exploration projects in Nevada.
Nevada. Now, that's not the first place that comes to mind when I think lithium mining. I'm picturing casinos, not like mines.
Right. It's interesting, though. Nevada actually has a really long history of mining. It's becoming a major hub for mining investment these days. And not just for gold anymore.
So what's drawing these companies to Nevada?
Well, for one, they've got business-friendly regulations, which companies always love. But get this, a carbon-neutral hydroelectric grid, thanks to the Hoover Dam.
Wow. That's huge for companies trying to appeal to environmentally conscious investors.
Huge. And it's just smart business. Cleaner energy sources often mean lower operating costs.
Makes sense. But are they just digging around randomly in the Nevada desert hoping to strike lithium? How do they even know where to look?
That's the thing. They're not just randomly digging. Grid Battery Metals is targeting specific zones that they've identified through careful exploration work.
So they're being strategic, following the data. It's like a high-stakes treasure hunt.
Exactly. And the treasure they're after. It's only getting more valuable as the EV market explodes. Did you know that 10 million EVs were sold globally just last year?
10 million? That's more than I thought.
Right. And they're projecting that number to hit 14 million this year. That's a massive amount of lithium and copper needed to power all those batteries.
Okay, now I see why everyone's so excited about this. It's like a modern-day gold rush, but for EV battery metals.
Exactly. And Grid Battery Metals is positioning themselves to be a major player. Plus, they're smart to highlight their commitment to ethical and sustainable mining practices on their website.
You're right. It's not just about digging up the earth anymore. Investors care about that stuff.
For sure. They talk about minimizing their environmental impact, engaging with local communities. It's a smart move.
It really is. It's not just about the bottom line anymore. But they do back up the financial side of things, too. Remember that stat about lithium-ion battery pack costs dropping 87% since 2010?
Oh, yeah. It's huge. Those lower costs make EVs more affordable, which further fuels demand. It's a beautiful cycle.
It all connects. Okay, so we've covered REITs, interest rates, these EV-related companies like Grid Battery Metals. What else is in our stack of sources today?
All right, let's shift gears a bit. There's this Market Beat article about something called triple witching.
Triple witching? Okay, now that sounds a little ominous. What in the world is triple witching, and why should investors care? Especially if they're interested in real estate.
So, triple witching is this Wall Street term, a little bit of jargon, I admit, that describes a specific market event. It happens 4 times a year.
And what happens during this mysterious event? Tell me more. All right, so we've got to talk dividends.
Can't forget those.
Definitely not, especially with that Fed rate cut still fresh in everyone's minds.
Right. You got to factor that in.
Big time.
Yeah.
And this Market Bait article makes a really good case for why dividend stocks deserve another look right now.
It's all about relative value when you really break it down.
Relative value. Okay, walk me through it.
Think back to when those interest rates were sky high.
Painful memories.
Right. Investors could get a pretty good, super safe return just holding bonds or parking their cash in a high-yield savings account.
Exactly. So dividend stocks really had their work cut out for them to compete.
Exactly. But now,
The game's changed.
big time. Those so-called safe havens are looking less and less appealing with these lower rates, which means those juicy dividend yields. Back on the menu.
Music to my ears. So which companies are catching your eye in this new landscape?
Market Beat highlights 3 companies in particular.
Hit me with them.
AT&T, Ares Capital, and VCI Properties.
Okay, so we've got a little something for everyone there. Let's start with good old reliable AT&T. What's the story there?
Solid dividend yield, 5.2%.
Not too shabby at all, especially in this market.
Right. Plus, their stock has actually been doing pretty well this year.
Really? I feel like they've been navigating some choppy waters in their industry lately.
They have. But even so, their stock is up over 27% since January.
Wow. Okay, so investors are definitely seeing something they like there. What about Ares Capital? Now, that one sounds a little more intense, if I'm being honest.
You might want to brace yourself because they're rocking a 9.25% dividend yield.
9.25. Okay, you definitely have my attention now. But come on, that almost feels too good to be true. What's the catch?
All right, you got me. You always got to be careful with those crazy high yields. Sometimes they could be a red flag for risk.
Right. Got to keep that in mind. But it sounds like Ares Capital does have a decent track record. The article mentioned they've had a 6.27% annualized dividend growth rate over the past 3 years.
Yep. They've got a solid history, which definitely counts for something. Okay, last but not least, VCI Properties.
VCI. Now that one rings a bell. Are they the real estate folks? See, we're coming full circle.
You got it. But not just any real estate. They specialize in gaming, hospitality, and entertainment properties.
Ooh, so think Vegas casinos, those fancy resorts, that kind of thing.
Exactly. And they're sitting pretty right now with a 5.06% dividend yield.
Okay, not as flashy as that 9% we talked about, but hey, a little less risk. Never hurt anyone, right?
Yeah.
What else makes VCI stand out?
Well, for one, they've been showing really strong earnings growth, which is always a good sign.
Absolutely. Who doesn't love exceeding those earnings estimates?
Right. Investors love that. And here's another thing that value investors will appreciate. They're currently trading at a very reasonable price-to-earnings ratio.
Woo! So they could be undervalued. Like finding a hidden gem with a solid track record, a decent dividend, and room to grow. I like the sound of that. It all comes back to what we were talking about earlier, REITs, and how this recent rate cut could really shake things up in unexpected ways.
Exactly.
And look at us now. We went from REITs to high dividend stocks to companies cashing in on the EV boom and everything in between.
And we even managed to squeeze in some essential investing concepts. Understanding market volatility, navigating those crazy triple witching days. It's all about having a long-term perspective.
It really is. It's like that classic saying, it's about time in the market, not timing the market.
Couldn't have said it better myself.
Yeah.
It's something to keep in mind as you explore all these different investment avenues.
Absolutely. Well, folks, we've covered a ton of ground today. REITs, dividends, EV battery metals, market volatility. It's been quite a journey. Any final words of wisdom for our listeners before we wrap up?
Here's something to chew on. All of this, all these companies, all this analysis, it's been very U.S. focused.
Which makes sense. It's where we're based and what we know best.
Exactly. But it's just one piece of the puzzle. Don't be afraid to expand those horizons a bit.
You mean go global?
Yes, exactly. Think international REITs, dividend stocks in emerging markets, maybe even those battery metal companies overseas. The possibilities are endless.
Love that. Expand those horizons, diversify that portfolio, never stop learning. That's some fantastic advice to wrap up this deep dive. Thanks for joining us today, everyone. Don't forget to subscribe and leave us a review on your favorite podcast platform. We'll catch you next time for another deep dive.
Boogers for breakfast.
That's it. It's over. It's all over.